Alright guys, check this company out. 1stDibs. Okay, at these prices, $2.50, $89 million valuation. Is this stupid cheap? Super small cap company, so most of you probably haven't heard of it. But basically it's an e-commerce company. Check out the website real quick. They sell luxury bags, furniture, lighting, and all that. Paintings. They have some rare stuff. Like most of the stuff they sell on their website, you probably can't get anywhere else online. Vintage dresses, vintage paintings. They sell Rolexes. Like some of the prices on here for some of these things: $16,000 for a Rolex watch. $30,000. Let's see what the most expensive watch is. 1.4. What is this? Guys, look at this thing. Cartier Vivid Yellow White Diamond Panther watch. See, like some of these things you can't get anywhere else. 1stDibs is one of the only marketplaces that sells all these rare items. Wow. Who's buying this? It's in 105 carts, $1.4 million for a Cartier Diamond Panther watch. That's crazy. Let's check out some of this vintage art. Okay, 300,000, that's not bad. Mid-century modern furniture, let's check this out. $1 million. I don't even know what this thing is. So yeah, online marketplace. They sell luxury items, furniture, bags, watches. They are known for pushing the antique businesses into the 21st century. Year to date, we're down 30%. Is this stock stupid cheap right now? Let's just look at some of the numbers. Warning, warning. Warning guys. Dibs is at high risk of performing badly from seeking alpha. The latest upgrade was in March of 2024. Currently no insider buying right now. Institutional ownership from 2021 looks like it's been flat. We had a little spike in 2023. Not too many institutional owners at all. Let's look at some of the financials. Cash flow, yearly cash flow. So for the 2024 year, they posted negative 2.9. I mean, compared to the year of 2022, they were posting around negative 27 million. So that's a huge improvement year over year. Looks like they are once again on the trend to becoming cash flow positive for the full year. So this looks pretty good. This their free cash flow per share looks promising. Balance sheet. Okay, so 20 million in cash, 80 million in short-term investments. So the value of the company is lower than the total amount of cash they have. Would this be considered a net? Let's see if they have any long-term debt. No long-term debt. All right, so 101 million in cash, no long-term debt, 35 million shares outstanding. Super small company, guys. Only 284 employees. And looks like total revenues for the year 2024, they made 88 million in total revenue from 2021, down 10%. And net income, still not posting any positive net income. Let's check out some of the quarterly data. I've already transferred it out into the sheet. Looks like total revenue, latest one, 22.5 million versus 22.1, up 1%. Total revenue flat. Earnings per share, looks like it's been bad, have been declining for the past 3 quarters. Profit margins look good. They're above 70%. So the company is making a lot of money. This is where we're seeing slight improvements in the business, is their free cash flow. Looks like for the 2024 year, they've been improving year over year on their cash flow. So I guess that's the plan of the business, is to improve their cash flow first, free cash flow per share, and then focus on growth. Good quarter one, posting -1 versus -9. That is up 88% in the quarter before that. So quarter 4 of 2024, they posted the first ever positive cash flow from operations, and per share up over 200% year over year. So huge improvements in their cash flow. Looks like they are focused on improving their cash flow first. Everything else seems kind of flat or went down year over year. Let's look at the transcript real quick, see if they say anything important. So currently the company is focusing on improving their GMV, revenue, and margins. The problem they're having is that the economy isn't in good shape right now. Challenging demand backdrop driven by macroeconomic factors. So not a lot of people have money right now. A couple highlights on the numbers. Net revenue for the first quarter was 22.5 million, up 2% year over year. And they ended the quarter with 101 million in cash. 1.8 million they spent on the previous quarter on share repurchases. So the company is currently repurchasing their shares, so definitely undervalued in the company's term. If they did a liquidation at these prices, they have more cash already. You also got to think about, so the main risks this company is having is the macroeconomic uncertainties and a weaker housing market. Not a lot of people are buying houses right now. No, not a lot of people are buying furniture. And now we currently have all this tariff war still happening, so prices might be going up. Reduced consumer discretionary spending. This is a big one. And currently management remains cautious but committed to sustaining growth. Besides having more cash than what the total market value of the company is worth right now, think about the network effects that 1stDibs currently has. They created this platform where buyers and sellers can connect with each other, which produces powerful network effects. So if this company could sort of improve the seller experience, the buyer experience, collect data, improve the platform. It could eventually do a turnaround. They are an asset-light business. They don't own any of their inventory. I mean, the buyers and sellers provide all the transactions. So they are currently scaling marketplace supply and demand across different verticals. Latest vertical, let's see, launch of Italian and Spanish locals. 2022, they launched in French and Germany. So they are focusing on little niche markets so far to grow. Slowly growing company. It looks like they have plateaued in the past 2 years, but remember guys, a company can't go bankrupt with no debt. They currently have zero debt, 101 million in cash. The platform is running, the network effects are on, and they're making $89 million in revenue for the year, 64,000 active buyers, 5,900 unique sellers, huge gross margin. Little by little, if they could keep acquiring different verticals, expanding into these niche little markets, eventually this company could turn around. They are one of the biggest e-commerce website that has a lot of trust on selling these high value items. So, I mean, besides eBay, you have Etsy, you have RealReal. No one else is selling all these different types of furnitures, watches, with the amount of trust that the company has built with the consumer. Do they really have a lot of competition? Like, what other website do you guys know sells all these rare types of products? I mean, look at this American flag right here. 1940s D-Day flag? One of the first American flags flown on June 6, 1944. They also do have a legit check. They have Birkin bags. $40,000. Let's check out the most expensive handbag. Birkins, of course. $425,000 for this Birkin bag. Guys, look at this. It's in 39 carts. It's in 147 carts. Guys, look at this Birkin bag. That's crazy. There are actually people out there looking at these bags, thinking of purchasing them. So there is some traction on this website. The stock price is getting pushed down hard. In my opinion, I think it is getting the stupid cheap levels. 111 institutions hold the company right now. Besides the $101 million in cash, which is already above the market cap, you guys got to value the website. We got to be able to value the intangibles. I think this company has a little competitive advantage compared to Etsy, eBay, RealReal. So let's definitely keep an eye on this company because I do think at these levels, it just seems stupid cheap. Maybe they announce a share buyback soon or insiders start purchasing, but as of right now, they are currently just using a little bit of their money to buy back their shares. So as we look at 1stDibs, one of the main things we should be asking ourselves in order for them to keep their competitive advantage is, will more people be buying luxury goods online in 10 years compared to they do today? And if the answer is yes, then this company is going to be doing fine. And it doesn't matter if they grow revenue 5%, 10% a year, which is slow, just as long as they keep growing. What matters is if they keep continuing to be the leader in luxury online purchasing. They have the infrastructure down. This is a platform company. It's an intangible asset that we can't put a quantitative value on. Has anyone else looked at this company? Let me know what you guys think below. Since the IPO in 2021, it's been doing nothing but go down. There is a trend to becoming cash flow positive. December 2024 is the first quarter where they posted positive free cash flow as a public company. Is this company at stupid cheap levels? $2.50, $89 million market cap. Let's keep an eye on this one, guys. Thanks for watching this video. We'll catch you on the next one.